Right. Live now? Hey, Michelle.
Howdy.
How's the life treating you?
It's going well. My kid's stuff ran a little bit late, so I picked him up, ran back here.
Hey. I was setting up all of the process for emailing our members on the new Adapt Advanced. So,
Perfect.
but I think I've got it pretty much ironed out, so I should be able to implement that today, in fact.
Fantastic.
So that's always an exciting thing. And
Mhm.
then all right, so as far as questions that got sent into us today, I mean, we're not quite up to time yet. I know we tell everyone 3:30, so I just kind of started this live because last time I felt like it took a little while for people to like realize like, oh yeah, and like get on, log on, and do all that, right?
Yeah, I have to go edit them when we do it, but I have to go edit last week's and I'll edit this one at the same time. So yeah.
Yep. Oh, you edit them when they go on to the recording on YouTube?
I'm going to. I think I should.
Oh, I didn't know that. I didn't know that we had the ability, honestly. Like the pre-conversation.
Yeah. Last week you didn't tell me you were even starting, so I didn't even know we were starting. So yeah, but I haven't had time to do it yet. So also we didn't remind people this week. So
Oh,
I
yeah,
mean, we've told them it's every week, but
right.
Um, are you going to start with any portfolio-ish stuff first, macro stuff first, or no?
Yeah, I'll touch base on kind of what's going on, but I mean, really, very little has changed. And then I'll let everyone know that we're live.
Do you want to cut it and restart, and then I don't have to cut this part out? Or does that mess with the link?
Um, I'd have to set up the whole thing. Yeah, I'd have to set up. Yeah,
Okay.
it would be a whole craziness. It's all right. It's part of live, right? We're just here waiting, talking, BSing, letting things go.
Yep.
I could start like a countdown. That would work.
Yeah. All right. Well, tell us, I guess, like, about the macro environment, if anything has changed.
Yeah. So here, I'll share a screen really quick, and we'll just kind of talk about in general how life is in the side of first like GDP now, and just kind of going from there. I'll present. So of course, just kind of as a general overview, I don't really kind of look, what's GDP now projections going. This is the Atlanta Fed and what they've came up with as far as their GDP projections. It is very, very, very high. We've basically been cruising up all quarter long, basically projecting that we're going to have a stronger quarter than what we would have had. And I mean, I think in general we can feel that. We can look at that across spending. We can look at that across credit cards, everything like that. There has been a pretty solid acceleration in GDP quarter over quarter, which has been helping kind of boost equities and assets in general. But of course, that's coming back into the back of what we're about to have, which is yet again another contraction. It was kind of like a short-lived little breather when the Fed decided to kind of pull back just a little bit and do a wait and see approach. But of course, as you started to see on the long end of the yield curve, we talked about this last time with inflation, and I'll pull that up really quick too so we can see that. With inflation, what ends up happening is there is hold on just a second. So with inflation, generally, what we'd like to see is this come down really aggressive, right? And this, start to come down here into this range that the Fed typically likes to keep, right? You can see back here to right 1.12. This is when they were kind of fighting inflation for it to come back. But one thing is that after a spout of deflation, you normally get this big inflationary spike. That's when the Fed typically dumps assets in and kind of spurs everything up, right? Well, coming into an inflation spike, if we were to be able to go back all the way back into the 80s, what ends up happening is you end up getting this inflation spike. It starts to cool down just a little bit. Historically, what the Fed has done is the Fed has not continued to tighten all the way until inflation is gone. What they've normally done is actually laid off the gas, or the brake per se in this situation, laid off the brake, and then inflation starts to come back, and then they've got to go in heavier again, right? And that's the second stage of normally those like inflationary recessions, like what we saw in 1973, 1974. Not so much in the 80s, because by that time it was pretty much the Fed at the time was like, we're done with this. We're just going to tighten into oblivion until we stop this thing. And that's really how they got it stopped. Of course, what happened this time around is the speed at which the Fed was tightening was creating a global issue on in the global economy, as far as the dollar getting too strong. Whenever the dollar becomes too strong against other currencies, it starts to weaken their economies. And that's normally a bad thing for a reserve currency. It starts to create instability. And then also at the same time, because of having a reserve currency, if you strengthen your currency too much by raising interest rates too fast, and it starts to depress everyone else's currencies versus that, it creates higher inflation for their economies, and then they end up having to raise rates in order to combat that, right? In order to combat that on an individual basis. So anyway, so it's exactly how the flow works is what we are deciding to do is kind of slow down and not hike rates as fast to kind of let the rest of the world catch up just a little bit, and then we'll go through another hiking cycle is basically what's kind of starting to be priced into the market. And that comes with this double dip recession type of talk, which is initially what we were calling for too. So had the first dip early last year. Of course, people didn't call that a recession, but it was a recession. And then we've had this little recovery, but this really isn't a recovery. This is just a calmness before the second dip that gets pushed down. Depending on how we deal with this second dip, though, is going to be really the thing that's going to be the most important. If this inflation stays higher for longer and the Fed keeps at these little 25 basis point rate hikes or something like that, it's going to be a lot longer drawn out, which means that the recession is going to last a lot longer, but it's going to be less severe to asset prices, but much more severe to the middle class, because inflation will erode their purchasing power for a longer period of time. We saw that in the 70s and 80s. Same concept, right? The misery index was straight through the roof. If you've never seen what the misery index is, go take a look at it. But as far as if they decide to kind of get this in one punch and get this inflation under control, then we should, in theory, see those interest rate hikes go a little bit faster, really kind of slam this down. But then the dollar will end up getting strong again, and that will create a deflation in asset prices, which would create a sell-off, and that would create what's more in line with a crash, right? I'm not saying a crash oh my God, it's Armageddon, but definitely something that's probably equivalent to something like what we saw in .com, where we start to really push down, and especially tech companies start to really take some heat, and we finally start to see unemployment spike. So that's where we're at as far as the grand scheme of things, and kind of just a general macro backdrop, just to kind of give you a base foundation of where things are going, why the portfolio, the awake and the sleep well, are also positioned into a situation where they are significantly more in line with a rising dollar right now. Now, I know the dollar had a bad day today, but it's just today, right? It's been on a tear for a while. So a little bit of a pullback would be normal. Like I said, it's all going to depend on how this Fed is going to end up taking care of these inflationary forces. And what this graph doesn't actually show you right here that I'm showing you on the screen is actually month over month, inflation actually accelerated. So we didn't get a drop in inflation. We actually got a rise in inflation month over month. The only reason that this number actually went down, though, was because the base effect was so low was so high from the previous year. So anyway, so that's where we're going with that. And then from there, I don't have anything else. So we can just probably jump right into some questions if there's some questions, or we can jump into a pre-prepared question. What's going on?
What we've been getting a lot of different questions about is how to allocate our different structures, our different programs against each other or with each other in cooperation. Okay. What's the best way to do that? And I'm not sure that I have a clear understanding on what pieces go into that. Could you kind of walk us through that? And then people who are using some of our programs also have some of their other own stuff running. They can kind of see how to compare those and run them side by side.
Yeah. So what things, I'm sure you've probably heard of some risk equations. Have you heard of Sortino ratio?
I'm not sure what it is. I've heard the words, but my degree is
Sharpe ratio.
Science, so I words. I don't know. No, I don't know what they are.
So perfect. So let's kind of just go into that, because I'm not saying that we should use a Sharpe ratio or a Sortino ratio or anything like that, but let's just kind of dive into what actually that is. And I know this is going to be really chicken scratch here, but let me just pull this up on a snippet so I can draw on this, and I can just kind of explain it to you in a conceptual way rather than getting into all of the math, because honestly, sometimes all the math just gets over people's heads. So let's just do this, share screen, and then we'll go over to this. Okay. So this is an equity curve of our adapt daily system, right? And of course, this is actually some older data, right? That's not including the newer data. Otherwise we'd be higher right here. But the whole point is if we look at an equity curve, so let's just imagine that this was an equity curve of whatever. It doesn't matter if it's the SPY, if it's a trading strategy, if it's futures, it's irrelevant, right? The fact is that we have what's called variance. So let's just variance I'm going to use. So variance is just how much this line fluctuates around, like let's say it's expected point, right? So if this has got a variance, like let's just call this like a 1, right? And then let's just say that this is, and we'd actually, here, we'll call this a 0.1 to just be a little bit more correct. And then let's say that we have another, and we'll just make this a wave right here. And let's say that we've got another strategy, and we'll just call this red strategy, that let's say, just for argument's sake right here, let's say it has the same return as far as its general profitability, right? So it's same return, but it has a variance like this, right? So there's Sharpe ratio. I'll just talk about Sharpe ratio first. Sharpe ratio basically says, hey, what's its standard deviation, right? Its variance, like how much does it swing up and down? And the more it swings up and down, the lower the Sharpe number is going to be, right? And the lower the Sharpe ratio number means that the less that you'd want to allocate to it. So let's just say that you've got like a Sharpe ratio, and I'm just going to throw random numbers up here just to keep things simple, 100. So if you've got a Sharpe ratio of 100 and you've got a Sharpe ratio of 50, right? You're going to sit there and go, well, technically speaking, right, per the risk profile of it, right, how much it returns versus the variance, you should have twice as much money as you have in this one, right? So if you've got these set up, that's how much you should have. That so you have twice as much money in this one as per this one, and then you can divide that across your portfolios. All right. Well, then we've got a Sortino ratio. So this is where it gets a little bit more complicated. So a Sortino ratio, right? So now we're talking about Sortino. So Sortino ratio, these, as much as we like to think and like in a perfect world that we have equal variance on both sides, that's normally not the case. So let's just say that in red, we have a lot of variance up, but it's really slow, whoosh, right? And this is kind of how it acts, right? This is its return profile, right? Well, what this is basically going to do is see these huge times that we have these big rallies. Like if you got a strategy that's doing that, you'd like that, wouldn't you, Michelle?
Yeah. Let's just have it do that forever. Perfect.
Right. So that's awesome. Now, what's nice about this red strategy, right, is that you notice that it doesn't just drop like a brick on you, right? It's kind of stable, but occasionally it has these big, gigantic booms, right? So what a Sortino ratio does is it basically says, hey, look, I'm not going to penalize a strategy or an asset for having these big booms. I'm only going to penalize them for its downside variance, right?
Okay.
So if we take both of these strategies together, a Sharpe ratio would say, oh, this has got a ton of variance in it because it's just, the price movement can move really fast. But that's kind of not fair because it's to your benefit if it moves fast, right? You just don't want to lose it on the downside fast, right?
Yeah, totally. Yep.
The Sortino ratio is a better measurement. I like Sortino better. That's just the way that I go with things. But anyways, then of course, it really, but what we're getting down to right here. So if a Sortino ratio says, hey, you can have 100 in Sortino, right? And then this other Sortino has a 50, right? Same thing applies, right? You have twice as much in this one than you have in that one, right? So nice and simple. That's a normal way that like some people can allocate to certain assets or things like that. Now, when you start doing that, when you start balancing everything based on a Sortino or based on a like a Sharpe ratio, you start to get into a world where there's something called risk parity. right? And what risk parity means is you basically take the variation, right, those ups and downs, right, and you equal weight each one of your assets according. So that's kind of what we're talking about here. Now, of course, we're equal weighting it based on a Sortino ratio, or we're equal weighting it based on a Sharpe ratio, or you're equal weighting it based on, maybe just a standard deviation, right? Which is basically the same thing as just risk. So that's kind of what, in general, a proper allocation model will do. There is another step that goes into this that, I'll talk about in general, but it's basically what's its correlation to the other assets in the portfolio. So I don't want to go too deep here because it starts to get really nutty. But basically, just kind of imagine here that we're going to take a correlation factor. So we're going to throw in an orange strategy in here. And let's just say that this orange one takes a loss right here. But then during these dead times in the red one, it has these big booms. And then all of a sudden it takes a loss right when this one's taking a win. And then it has these big booms again, right? So you can see that red and orange are kind of offsetting each other in a way, right? So what that does is that would start to tell you that you could then blend orange and red together and decrease your absolute risk because of their inverse correlation to each other, right? So the more something is uncorrelated to another, the better it is in your portfolio because it decreases your overall portfolios or your overall accounts volatility, right? It's variance. Downward specifically is what we're focusing on, the downward volatility. And so that's the way that you kind of want to blend everything together. Now, I know that our question was probably a little bit more geared towards our strategies. And our strategies have, because they're on different time frames, have some pretty significant non-correlation to them, right? So at that point, the best thing that you can do, since they're so uncorrelated and they're so they're so consistent, then you start looking at basically the simpler version, which is, hey, let me just do a basic Sortino ratio, or you can even simplify it further. You can just basically say, hey, what's the max drawdown that it has versus its CAGR, right? So that's a really simple way to do it. So if you've got a CAGR of 300 and you've got a max drawdown of 22, like our intraday calendars, right? But then you've got, and I know the CAGR's higher than that, but I'm just kind of throwing this out there. But then you've got another strategy that's a 500 and it's got a CAGR of 16, or not a CAGR, but a drawdown of 16, right? So you can start using a ratio on this, and you can just do, 300 divided by 22, and then 500 divided by 16, and just to make things nice and clean, I could just here 3 divided by 2. So you've got a 13.63 over here, and then you've got a 31.25. All right, so you've got a 13 up there, and you've got a 31.25. And really what's important about this is that you're measuring both in the same way. You're basically taking their max drawdown, which is their risk, basically. Let's just assume that that's their risk. I like max drawdown better than, like variance or standard deviation, because what standard deviation or variance is not going to pick up, it just depends on your windows that you're picking up those standard deviations. So if you're measuring everything based on a 1-day standard deviation and you're putting those together, that only matters if you're going to allocate between those two strategies every day, right? That's when that matters. But if you've got a strategy that you're allocating to on a per trade basis or something like that, then you really want to do, okay, what's a time frame that these are equal to? And what I like about max drawdown is most of the time max drawdown is relatively going to take care of the two time frames together. It's not perfect because if you're on a daily time frame and your max drawdown is, it happens over 1 week and then you're out of it and you're right, you've popped back up to new highs versus something that takes 3 months to get to its max drawdown, something like the adapt advance, right, where it takes a really long time to get to its max drawdown because it's so much more stable. Then allocating based on max drawdown isn't quite as fair because the adapt advance doesn't actually have as much risk on that max drawdown basis per that time frequency, right? So you want to make sure that everything's roughly looking at the same time frequency. So something that you might want to figure out is like if you've got a weekly trade and a daily trade, then you might if you're going to rebalance those two on a weekly basis, look at your dailies and say, hey, that draws down this much in 1 week. So that's my 1 week drawdown risk versus the 1 week risk in the weeklies, right? So you can balance it out on a time frame basis, right? Or like I said, or you can go to like, hey, my max drawdown on my weeklies is, say, takes three weeks, or say it takes a month to get to your max drawdown. And then you can also look and say, okay, what's my max drawdown I've ever seen in my dailies over a 4-week time period, right? And that would help, right? And that's when you're rebalancing. So just to kind of dig in a little bit further there, but in this example, 13.63, right? You can sit there and say, I mean, I'm just saying, rough ballparks here. That's roughly 2-to-1 also, right? But you can actually just take this ratio and you can figure out what it is right there. And you can say, okay, I need this much more than this one. In this case, it would be, let's see here. So you put your total up here. So if you've got, let's say that you've got 13.63 and 31.25. And here I said I was not going to try to get too deep into the math here. But anyways, so 13.63 plus 31.25 is 44.88, right? And that's going to be your total, right? So that's if your total. So then you can just do a ratio on this. So then you can sit there and do 44 down here. And I'm just going to leave it at 44, but 13.63. So roughly speaking, that's 30% of your capital, 31 roughly, but 31% of your capital goes into this guy, and then the remainder would go into the stronger risk over reward. Basically, I'm using CAGR as reward, and I'm using drawdown as risk. So that's kind of how you would start to balance these two strategies. So I probably lost some of that in there, but what do I need to dig in more of?
Well, okay, so I understand better how to match the different option strategies themselves against each other.
Okay.
Is there anything else that you're looking at when you're looking at like a portfolio, like Sleep Well and Awake? How much of that to run in options total? And then I assume once you get the amount of options total, then you break down the different, you put the options pieces together to make that whole, or what's the order of operations on that?
Yeah. I mean, I hear what you're saying there. So the way that I do it, right, and I'm not saying that anyone can do it, but yeah, if you're breaking down into like asset classes, and let's say that you wanted to break it down into asset classes, like what you're talking about, like here, I want this much in my long only portfolio. I want this much in my options portfolio because of, let's say how much variance they have. So like, let's say, hey, my options portfolio or my options trades in particularly swing up and down, say 20%, right? Let's just say all of them combined swing about 20% to the downside, right? And my long only portfolio, like Awake, so we're just going to call this options over here, opt. And then let's say Awake, right? And Awake is a leveraged long only, and especially in bull markets and during certain times of macroeconomic cycles, it can explode, right? I mean, we saw just a couple of years ago, we saw like 135% a year. For the whole point behind that is that the awake draws down, roughly speaking, right, 12 to 13%, right? So if you're sitting there 12 or 13, let's just like ballpark that to about half the risk of what's in options, right? That would say that you'd want your, roughly 66 over here and your 33 over here in options, right? If you're trying to balance out your risk. Now, that's not always comfortable for everyone, because someone might be like, oh my God, my options are 33%, right? And that might be a little bit uncomfortable. So it really does kind of come back down to like a personal risk tolerance as well. Some people mentally don't want to live by the numbers and optimize a portfolio based on numbers. There's maybe like, because options have a absolute risk in them, right? Say like a catastrophic event of like just kaboom, right? A market event, and it gets completely wiped out, which doesn't exist in Awake, right? Because for an asset to go all the way down to zero is like, it's almost impossible, right? Now there's drawdowns that can happen to it, but that's there. Now, granted, we have leverage in Awake, so the odds of an absolute risk is higher, because when we're leveraged up all the way up, and let's just say we're like solo in something like 3x the S&P 500, then a 33% drawdown would blow out the account. Right now, we didn't see anything close to that, even in COVID, even in 2008, even in synthetically in like 1987. Like, none of that has ever happened. But we can just talk about that in general, like if that's the potentiality there. So trying to balance that out is kind of a little bit more in line. Like the SWP, the Sleep Well portfolio, that actually has, roughly speaking, at about like a 10 to 11% max drawdown that it's seen historically. It's not saying that it can't exceed that, right? Same with Awake. But that only has a return significantly lower than Awake, right? The Awake is, I think it's almost 50%, whereas Sleep Well portfolio sticks to that like 12 to 15%. And that's because it's not leveraged at all, right? And without having that extra juice, that extra leverage, right, you can only do so much on the upside, whereas Awake can actually leverage up. So going into this a little bit further, it just goes into kind of personally speaking, how to get away from these numbers. You can still generate, hey, what's my risk in options? What's my risk in a long only portfolio? And then balance it out accordingly. But then you also got to ask yourself, am I really comfortable with having 33% of my assets in options or option strategies? Maybe if they're intraday. So let me break this down too. Our option strategies, like the intraday, right, that we both run, the calendars, right, those guys, we only have, most of the time, 12 to 20% of that allocation even at risk on a single day, right? And it depends on your risk level as well, right? Because you can actually reduce that down and have a little bit more in cash. So since you're watered down in cash, even though that's allocated to those option strategies, it's also kind of watered down in cash as well. So that's something to think about too. And you can always throw that cash into like short-term maturity bonds and stuff like that, because you're not going to use it for a while. But anyways, that's if you're trying to get some more efficiency. I digress. So did that clarify it a little bit more?
Yeah, I think that's super. Yeah, I'm not sure that I would quite be able to go through it on my own, but I at least know kind of what you're looking at when you do it.
Yeah, and I mean,
probably could figure it out. Yeah.
Just to focus a little bit more on it, like in a perfect world, right? And just in a perfect world, you could run two options trades against each other, right? And look at what their correlation coefficient is. And let's just say in a perfect world, you have a trade that makes about the same amount as this trade, but basically has almost opposite correlation, right? You can see here every time this is up, this one's down. Every time this one's up, this one's down. What that starts to do is instead of just balancing them on a risk ratio, you can actually start to augment this a little bit and say, hey, if I rebalance on their drawdown cycle, so let's say that this drawdown cycle is typically 1 month, right? So this is a 1 month time frame, is their drawdown cycle. What you could do is do a rebalancing on a monthly basis. So I'm doing a 1 month rebalance. So that's my plan, right? And that's because I'm using the cycles of the drawdowns within the two strategies. And like I said, I'm talking about a perfect world where they both match up perfectly. So 1 month rebal. And what I can actually do here is if one has more volatility than the other or whatever, I can actually adjust the correlation coefficient to amplify the total returns. And instead of getting two strategies that perform like this, but when you smack them together and rebalance on a 1 month basis, surprisingly, you can actually get a very smooth line that actually outperforms both strategies on their own and is smoother than both strategies on their own. Like I said, that's in a perfect world. And that's what's called the efficient frontier, right? If you've ever modern portfolio theory, right? You know, I'm just kind of drawing a little picture of the efficient frontier. But that's basically what that starts talking about, right? Is where certain mixtures of assets or strategies together at certain correlation points and rebalanced at specific time periods can actually optimize your return per risk ratio. And, you know, that's somewhere around here is where that efficient frontier is. And it just depends on where the risk-free rate is.
Okay. We have a question. What's the approximate backtested standard deviation of the daily adapt?
The standard deviation of it on what time frame? Well, here I'm just on a monthly basis. I think the standard deviation of it is, oh man, you know, I'll have to pull that up. Its drawdown is 16% on its full risk, so that's basically like 100% of whatever you're allocating to options on that. Its max drawdown is 16%, and I'm just throwing this off the top of my head. I'll go look and I'll send it to you. Send an email to us and I'll be able to send you that exact information if you'd like.
Yeah, that's a good way to do
But
it. Because we definitely asked you out of the blue.
Yeah, I mean it's somewhere around the probably 6 to 10% range, but it's just like pure variance isn't really good with that because that's also going to pick up upside and downside. And so its downside is lower than its upside, though. It's asymmetric on its variance.
Excellent. Anything else from anyone else? I think that's the only topic we had percolating for this week.
Yeah, allocating capital is a really important piece. I mean, if you're not allocating capital right and you're not rebalancing on the right time frame, you're leaving a lot on the table. Surprisingly, I mean, when I started getting into the institutional realm of things, and I started to realize how important rebalancing specific strategies off of each other were. Right, that's what I did at the fund. Is like, hey, if we take a certain amount of risk over here and we take a certain amount of risk over here and we rebalance them on the frequencies in which they are, or you can even rebalance them based on their actual drawdowns, right? Like for instance, you can force a rebalance in the middle of a drawdown in one of the strategies if you have two uncorrelated strategies. And so that way you're not necessarily pulled into a time frame per se, but you're actually looking for those max drawdown numbers or those higher than normal drawdown numbers to force a rebal. And what that does is it typically will take money away from the strategy that's been doing better and put it into the strategy that's been doing worse. And then as they mean revert, you can actually get amplified results. And that's another way to, like I said, achieve more return with less risk, even though it sounds scary when you're rebalancing to a strategy that's drawn down, it's just a statistical way of doing it, and it takes a lot less risk. And so what I'll do is I'll scale up into strategies that are actually underperforming, as long as there's not a fundamental breakdown in it. And once there's a fundamental breakdown in it, I'll normally call it, right? Once it gets a certain point past its max risk, parameters, once it's done, like whatever it's done historically, or whatever it's done through a Monte Carlo simulation, I sit there and I go, oh man, I'm really way out there on the statistical terms. We probably need to, pull this back and see what happened in it, and see if there's a fundamental problem in it.
Mm-hmm. Excellent. I don't see any other questions on this topic. So
great.
Yeah, email us during the week, and we will add them to the list for next week.
Absolutely. It was always great talking to you guys, and thanks for the questions, and we'll see you guys next week.